Is there a perfect investment strategy for retirement? Welcome back to the channel. My name's Keith. I'm a financial planner, and my focus is retirement planning. Today, we're diving into a crucial topic for those who are in retirement and those who are approaching retirement. Simply put, what investments should I choose for my portfolio? This is called asset allocation. Whether you're planning to retire soon or already enjoying retirement, this information is so important if you want a confident financial future. Asset allocation is the process of allocating your investments among various asset classes, such as equities, fixed income, commodities, real estate, precious metals, alternatives, cash, etc. In other words, diversification. The more concentration that you have in one kind of investment, the more eggs you have in that one basket. And you're not supposed to put all your eggs in one basket if you're trying to protect your money. So if you're trying to lower your risk and you want to invest in different types of investments that have different kinds of risks, or asset classes, this can help balance your risk to reward. For example, if your portfolio is invested 100% in highly volatile stocks, then you're exposing yourself to a lot of volatility. Volatility is like riding a roller coaster. The higher the volatility in your investments is like a really extreme roller coaster with really high highs and really far down lows. But if you own, let's say, less volatile stocks, bonds, annuities, asset classes with less volatility, then your portfolio inherently will not be as likely to have massive losses and will be a smoother experience. Typically, the amount you invest in different asset classes is determined according to your retirement needs. Your preferred risk tolerance, which is how much volatility are you emotionally comfortable with. So, think about that roller coaster that's going up and down. How much of that up and down do you emotionally want to have? Sometimes people can't stomach the really high volatile experience. So that's one aspect to consider. We also want to take a look at what's called time horizon. Time horizon is how long before you need to take withdrawals from your investment. And then after you start taking investments, how long will you continue with this investment? So the longer time horizon that you have will allow for more volatility and hope for more overall growth. If your time horizon is shorter, you can't really handle as much volatility exposure, so you should have less volatility. For individuals at 60, your asset allocation can make a significant difference in your retirement experience. Simply put, we need to have enough growth to meet your needs, but we also don't want to have a lot of volatility so you don't run out of money early. Before we dive in, don't forget to hit the like button and subscribe for more retirement insights. When determining the best asset allocation at age 60, there's several factors that we should consider. Number one is risk tolerance. The way I like to talk about risk tolerance is your emotional preference when it comes to the roller coaster experience of investing, along with your comfort level of total risk to your assets. So if the stock market were to drop tomorrow by 40%, how comfortable are you with your exposure to that downside? We know that the stock market goes up and down. That's what the stock market does, right? When the market falls by more than 10% in a year from a high point, that's actually a normal occurrence. That happens almost every year. We also know that in decades, there is a significant stock market decline like the early 2000s, 2008, and even 2020 with COVID. The market was down over 30% in a quarter. And just to be clear, the market typically recovers from these normal corrections within a few months. Even COVID was recovered very quickly within a few months. But the question I'm getting at is, how comfortable are you emotionally with riding that roller coaster experience? I mean, this is your life savings we're talking about. Many people at 60 prefer a more moderate approach with lower volatility and reduced stock market risk. Number 2, withdrawal rate. How much money do you need to withdraw from your investments above and beyond your other income sources? So if you have Social Security, retirement, pension income, rental income, annuity income, any other kind of fixed income sources, those are not relying on your portfolio's performance. So the income you need above and beyond your fixed income is your withdrawals from your investments. And any income from your investments is subject to something called sequence of returns risk. This simply states if you have losses in your portfolio and you also need to sell those assets to create cash so that you can spend that money and go to Disneyland, you may end up putting yourself in a position where your portfolio declines and goes into a tailspin, and you can sometimes run out of money early just from the order of withdrawals based on volatility. So the amount you withdraw from your portfolio will determine how much of this risk you have. For example, if you're withdrawing less than 5% of your portfolio each year, this is widely, assumed to be a healthy, sustainable amount based on historical studies that have been done. If you need to withdraw more than 5%, you may need to reduce your withdrawal rate at some point in the future to sustain your portfolio long-term if growth hasn't really sustained that larger amount of income. I've created a video all about sequence of returns risk if you want to check that out. And in that video, I go into detail about the math and really what that risk is and what you need to know about it. Number 3, income needs. Oftentimes, you'll have 2 different categories of spending. One would be discretionary expenses and non-discretionary expenses. The non-discretionary expenses refer to all of your basic lifestyle needs that you can't go without if you had to. So groceries, mortgage, utilities, phone bill, things that are just kind of the basics of life. The discretionary expenses would represent things that you can go without if you had to, such as traveling and hobbies, extra expenses that if you really needed to cut back in a tough year or a tough period, you could cut back a little bit on some of those expenses. And some of your expenses will only last for a certain amount of time, such as your mortgage. If you have a mortgage that will be paid off, let's say in 10 years, or perhaps you want to travel in retirement, but you don't want to travel forever. Maybe you want to travel up until a certain age 80, age 85, but then after that, you're really not going to be traveling as much. So your income needs will determine how much you need to withdraw from your investments, which really has an effect on your asset allocation. Number 4 is inflation. We all know inflation that is a problem, and the value of the dollar is going down over time. This means that we have to invest our portfolio in a way where we have enough growth to outpace inflation and also provide for the income that we need in our retirement without running out early. So we can't simply invest our portfolio in cash and be really conservative to the point where we don't have any growth, because inflation is going to erode that money and we probably won't be able to make it last forever. But we also can't be too conservative with certain investments that just only keep pace with inflation, because if you also need to withdraw from your portfolio, that's going to decrease the value of your portfolio over time. So in conclusion, we need to have enough growth for inflation and your needs for spending. So even if we want to be more conservative, we still need to have some money that's set aside for growth. Number 5, tax considerations. When considering asset allocation, we also need to understand something called asset location. Asset allocation refers to what investments you should have. Asset location is where you should hold those assets. So there's 3 types of accounts you can have that all determine taxes in a different way. There's the taxable money, which is like a brokerage account that's not a retirement account, and the taxes are determined based on the investments you have. The second category would be your IRAs, your 401ks, your 457, 403b, those are the tax deferred retirement accounts where that money's never been taxed before, and it's going to be taxed as income when you withdraw it. The third kind would be your Roth accounts. Those are going to be tax-free growth if you take it out, at the proper age. tax-free income when you take withdrawals. So let's say you own a stock and you own that stock in a Roth. Any growth that you have in that Roth is going to be tax-free. If you own that same stock in an IRA, all the growth is going to be tax deferred, but eventually when you withdraw the money, it's all taxed as income. If you own the same exact stock in a taxable account, which would be a non-retirement account like just a regular brokerage, then the taxes are based on the investment. So if you own that stock and you, let's say, hold it for more than a year and then you sell it for a gain, that would be classified as a long-term capital gain in the year that you sell the stock. Any dividends that are paid out during the time that you own that stock in that kind of account, those dividends are taxed as well each year. So the location of your investments determines what kind of tax liability you would have. And there's also in that taxable account, stocks are taxed differently than corporate bonds. The interest on corporate bonds is taxed as ordinary income. We have municipal bonds, which can be tax-free. So the location of the investments will determine the taxes, but also what kind of investments are you investing in will determine the taxes if it's a non-retirement account. Let's look at some common asset allocation strategies for age 60. A conservative strategy might be 20% equities and 80% fixed income. Now, I said equities and fixed income because I'm not necessarily just saying stock and bonds. Equities are commonly, referred to just in stocks, but there's many different ways to have exposure to equities. You could have exposure to equities through mutual funds, ETFs, stocks. You could even include, options and different, alternative strategies that have exposure to equities, but let's just call it 20% equities. And then fixed income, we're looking at all sorts of different bonds. I mean, everything from treasuries, corporate bonds, municipal bonds. There's a lot of different vehicles that you can access within the fixed income world. But the idea is the bigger picture, the macro of 20% equities, 80% fixed income. So in this example, Mary, let's say, is 60 years old. She's retired. She prefers minimal risk. Her allocation is focusing on bonds or fixed income vehicles because she wants less extreme of that roller coaster experience. She's seeking stability and consistent income. That being said, she also needs to have enough long-term growth to cover inflation and the longevity of her account. So she is allocating a little bit to equities to make sure that she has some exposure to more long-term growth potential for her portfolio. The balanced strategy, let's say, is a 50-50 split, 50% equities, 50% fixed income. So John is seeking a balanced approach between growth and income. His portfolio includes an even mix of equities and fixed income. He wants growth, but not too much volatility. So this is the more common of what I've seen in retirement is people want to have growth, but they also don't want to have too much risk or volatility. The third scenario would be the growth strategy. And there's always an extreme on either end where you can be really aggressive or really conservative, but these are kind of normal retiree windows of conservative moderate growth. So the growth strategy is going to be 80% equities and 20% fixed income. So basically the opposite of the conservative. So Susan, she's comfortable with more risk. She wants her portfolio to grow. She also doesn't need as much income from her portfolio because she has a large pension. So the amount of income that she needs from her portfolio is less. She desires to have more growth. She's okay with having some of the volatility, and she can handle it because she has this large pension. So that's a growth example. Now you might be thinking, if I go with an asset allocation approach with, let's say, stocks and bonds or some other investment vehicle, how do I know which to pick? How do I know which stocks to pick or what bonds to pick? Well, this is not something I recommend you tackle on your own. I highly recommend you seek out professional help with the execution of your portfolio management. With professional help, you can gain the resources of large institutions with market research, and they can help you adapt to the ever-changing markets. There's so much to know about stocks and bonds and all the different investment vehicles that it's just highly, highly recommended that you find a professional who can help you. But make sure that you find an advisor and a firm that gives you attention. They should know you very well. They should understand the intimate details of your financial situation to make sure you're getting the very best service ongoing. I highly recommend you find an advisor who will create a detailed retirement plan for you to make sure your asset allocation is customized for your needs, not just a basic portfolio that they would throw everyone into. Whatever you and your financial planner decide is right for you, it's essential to regularly review and adjust your asset allocation as you age, as your financial situation evolves. Major life events and market conditions or changes in your financial goals may be necessary for you to make adjustments. Rebalancing your portfolio, which is buying or selling assets to maintain your desired allocation, can help your investments remain in your desired asset allocation. For example, if you are desiring a 50-50 split and your stocks grow faster than your bonds, you may find yourself with a 60% equity position and a 40% fixed income position. So rebalancing is simply selling some of your stocks and reinvesting in bonds so that you get back to that 50-50 split. Determining the best asset allocation can be complex. Consulting with a retirement specialist can provide personalized guidance tailored to your unique situation. At Summit Wealth Strategies, we offer comprehensive retirement planning services, including asset allocation recommendations based on your goals, risk tolerance, financial needs. Our expertise ensures you will have a robust plan for a secure and fulfilling retirement. But regardless of if you choose us as your provider, please make sure to work with a specialist, not just someone who's going to sell you a product. Thanks for watching. If you found this video helpful, please like and subscribe to our channel. And for more detailed information, check out our blog posts listed below. Visit our website for more resources and to schedule a consultation with one of our specialists. See you next time.